Welcome to The Sensible Investor, the podcast where we cut through the noise to help you build wealth patiently and intelligently. I'm your host, Kate. Today, we have a guest back with us to do a deep dive on a single stock that in many ways defines the modern economy. Mark, thanks for being here.
It's my pleasure, Kate. Thanks for having me.
So, Mark, we're going to tackle the titan of the market, a company that needs no introduction, Apple. I don't even need to spell out the ticker. As of this week, its market capitalization is hovering around a staggering $3.2 trillion, making it one of the most valuable and widely held companies on the planet. For many, it's the beginning and end of their investment research. So let's start with the bull case. In your view, what is the fundamental argument for buying Apple stock in mid-2025?
The bull case for Apple is a masterclass in modern business, and it starts with its ecosystem. As of early 2025, Apple reported an active install base of over 2.35 billion devices. That number is just staggering. But when we look beyond the number, what's more impressive is the vertical integration, the seamless way messages, photos, and files move between an iPhone, an iPad, and a Mac makes it incredibly inconvenient and socially costly for users to leave. It's a walled garden, and once you're inside, the walls are very comfortable. This is why Apple enjoys a customer retention rate of 90%. Once you are in the ecosystem, you are in for good.
And that massive, captive audience is now being monetized more effectively than ever through the services division, which has been the real growth story for a while now. Can you break that down for us?
Absolutely. For years, Wall Street worried that Apple was just a hardware company, subject to the boom and bust of product cycles. The services division is the answer to that fear. In their last quarterly report, services revenue hit over $26 billion, growing at a strong double-digit rate. And crucially, the gross margin on services is over 70%, nearly double the margin on their hardware products like the iPhone. This division isn't a monolith. It's a whole suite of recurring revenue streams. The 30% commission from the App Store, billions from Apple Music and TV Plus subscriptions, iCloud storage plans, Apple Pay transaction fees, and a rapidly growing advertising business. If Apple's service segment was a separate company, it would have been a Fortune 50 company with its revenue generation, and it's incredibly predictable.
So the ecosystem feeds this high-margin, reoccurring revenue business. What's the third pillar of the bull case?
It has to be its financial fortitude. Apple is a fortress. They generate immense operating cash flow, often over $20 billion in a single quarter. This allows them to do two things that directly benefit shareholders on a massive scale. First, they have a colossal share buyback program. The board recently authorized an additional $100 billion. This is a tax-efficient way to return cash to shareholders by reducing the number of shares outstanding, which makes each remaining share more valuable. Second, they consistently pay out and grow their dividend. It's a machine built to methodically return capital to its investors.
An unbreachable ecosystem, a high-growth services division, and a rock-solid financial position. It sounds incredibly strong. Sounds like a perfect place to put your money. But no investment is without risk. Let's flip the script. What's the detailed bear case against Apple?
The biggest con is a classic problem for giants, the law of large numbers and its current valuation. At a $3.2 trillion valuation, the physics of finance make explosive growth nearly impossible. The company is now guiding for low single-digit revenue growth, yet investors are paying a premium price with a PE ratio of over 30. For context, the average for the S&P 500 is closer to 20 to 25. You're paying a growth stock price for a company that is now behaving more like a mature value company.
That valuation is steep. And is the company's success still too concentrated on one product?
It is. Even with the growth in services, the iPhone still accounts for the majority of their revenue, around 55 to 60% in a typical quarter. The global smartphone market is saturated, and upgrade cycles are lengthening. In the US, Apple has a dominant market share, so there's little room to grow. In China, its other key market, it's facing intense pressure. Any significant dip in iPhone demand could still really hurt their bottom line. We don't see it happening anytime soon, but things can change very quickly in the tech world.
You mentioned external threats earlier. Can you elaborate on the regulatory headwinds? They seem to be getting more serious.
They are a massive and growing concern. This isn't just a fine here or there, it's a direct assault on their business model. In the US, the Department of Justice's antitrust lawsuit is directly targeting Apple's walled garden ecosystem. The DOJ argues that Apple illegally maintains a monopoly by stifling the growth of super apps, suppressing cloud gaming services, and degrading the quality of cross-platform messaging. In Europe, the Digital Markets Act, or DMA, is already forcing Apple to make changes, like allowing alternative app stores, which directly threatens their high-margin App Store commission structure. These legal battles are costly, time-consuming, and create a cloud of uncertainty.
And the other major external risk is geopolitical, specifically China.
Yes, and it's a two-pronged risk. First, China is a huge consumer market, and Apple recently reported a revenue decline there as nationalism and strong local competitors like Huawei and Xiaomi gain ground. Second, and perhaps more importantly, it's the cornerstone of their manufacturing supply chain. Apple is acutely aware of this risk and is making very public efforts to diversify into places like India and Vietnam. But this is a slow, incredibly complex and expensive process that will take years. Any major escalation in trade tensions could be devastating to their production capabilities.
So we have the bull and bear case for the current business, but for a stock with this valuation, investors are betting on the future. Mark, where does new growth come from?
That's the multi-trillion-dollar question, and it's a bet on unproven categories. First is the Vision Pro. While the technology is revolutionary, sales have been modest. The bull case is that it slowly becomes a new computing platform, finding a strong foothold in enterprise, design, and medical fields first. The bear case is that it remains a very expensive niche product for developers and enthusiasts, never achieving the mass market appeal of the iPhone. We might see a more consumer-friendly M5 version late this year, but its future is still very uncertain.
And the second pillar is obviously AI.
Right. Apple was seen as being behind, but their new Apple Intelligence strategy is very deliberate. Instead of focusing on all-powerful cloud AI like Google, they are focusing on on-device AI that leverages their custom silicon. They're selling it as AI for the rest of us, with a strong emphasis on privacy. The investment thesis here is that these AI features will be so useful and seamlessly integrated that they will drive a massive hardware upgrade cycle, getting people to buy new iPhones, iPads, and Macs. It's a smart strategy, but it's still unclear if it will be as revolutionary as they hope.
I can't help but wonder if Apple will get AI correctly when they struggle to make autocorrect work on my keyboard, though. Anyways, one final question, Mark. If an investor has money for big tech, why Apple over, say, Microsoft or Google?
It comes down to the business model. Microsoft is fundamentally an enterprise and cloud company with Azure. Google is an advertising and data company. Apple is a premium consumer hardware and ecosystem company. If you believe in the long-term power of brand loyalty and high-end consumer electronics and the high-margin services built on top of that, you choose Apple. If you believe the future is an enterprise cloud or AI powered by massive data centers, your choice might be different. They are all tech giants, but they're playing very different games.
A very thorough breakdown. So to summarize, the investment case today is a balance between the company's current, incredibly stable and profitable business weighed against a high valuation, significant regulatory and geopolitical risks, and the uncertain potential of future catalysts like the Vision Pro and AI.
That's it exactly. Buying Apple today is not a bet on hypergrowth. It's a core holding for a patient long-term investor who understands the risks and believes in the enduring power of the brand.
A sensible but cautious investment. A perfect summary. Mark, thank you so much for your detailed insights today.
My pleasure, Kate.
That's all the time we have for The Sensible Investor. Join us next time as we break down another investment opportunity.